My name is Noah Cosby, and today I'm recommending a buy on Lamar Advertising Company with a 12-month price target of $174 against the current price of roughly $158, implying about 10% upside. Lamar owns roughly 159,000 billboard faces across 45 states in Canada. Advertisers, whether that be local businesses, national brands, law firms, restaurants, healthcare providers, or even political campaigns, all pay Lamar to rent advertising space on those billboards. About 80% of company revenue comes directly from billboards. The thesis itself rests on three pillars. The first is the digital conversion strategy and the economics behind it. The second is Lamar's UPREIT acquisition structure, which gives them a competitive advantage in industry consolidation that nobody else in out-of-home advertising currently has. The third is management's long-term capital allocation discipline, which I think has consistently validated shareholder value creation um, over the course of many periods. Financially, the company generated approximately 2.27 billion in revenue last year, while operating at adjusted EBITDA margins around 45.7%, which is roughly double that of their competitor Outfront Media. Net leverage currently sits near 3.3 times, which is also materially below Outfront. Importantly, Lamar maintained its dividend throughout COVID, while many competitors either suspended or materially reduced theirs. Outfront completely eliminated its dividend during that environment, while Lamar continued supporting shareholder distributions despite one of the most difficult advertising environments in decades. Roughly 75% of Lamar's billboard inventory is classified as legal non-conforming. What that means is these billboard structures were built before current zoning and highway regulations existed, so they're effectively grandfathered in under today's laws. The Federal Highway Beautification Act, alongside state and local restrictions, has made it extremely difficult to build new billboard supply across the United States. So, unlike most real estate sectors, Lamar is not competing in an environment where competitors can continuously add supply beside them. The supply base is effectively frozen. That creates a very strong regulatory moat around the company's 159,000 plus billboard faces across North America. At the same time, demand for digital out-of-home advertising continues to accelerate. Industry growth came in at roughly 3.6% last year, while digital out-of-home specifically grew over 10%. Lamar's own programmatic advertising revenue grew 25% last quarter alone. Where this becomes interesting is that the United States market is still only around 30 to 35% penetrated from a digital billboard standpoint, while countries like the UK and Australia are already above 50%. So there is still a very long runway for digital growth conversion. That transitions into the first pillar of the thesis, which is the digital conversion economics themselves. A traditional static billboard can generate roughly 3,000 a month in revenue. After Lamar converts that same structure into a digital face, revenue generation can increase to roughly 15,000 to 18,000 per month, depending on location and demand characteristics. Management has stated that the average digital conversion costs around 200,000, while the payback period generally comes in under 2 years. That is extremely attractive return profile, especially considering the company is largely funding these conversions internally through operating cash flow rather than materially levering the balance sheet. Today, Lamar operates over 5,600 digital displays across 45 states in Canada, and management has guided toward approximately 350 to 375 additional conversions annually through 2027. Programmatic advertising also continues becoming a larger contributor to growth. Management specifically described the industry as being in the third inning of adoption, which suggests the growth opportunity is relatively in its early stages. The second pillar of the thesis is the company's UPREIT acquisition structure. The out-of-home advertising industry is still highly fragmented, with many billboard operators remaining family-owned businesses that have existed for decades. The issue historically is that these owners often sit on massive unrealized capital gains. Selling for cash creates an immediate tax burden, which discourages consolidation activity. Lamar's UPREIT structure changes that equation. Instead of forcing sellers to take cash, Lamar can allow operators to contribute their billboard assets in exchange for partnership units that convert into Lamar stock on a tax-deferred basis. This essentially gives sellers the ability to convert a liquid family-owned businesses into liquid public security without immediately triggering taxes. What makes this especially important is that Lamar is currently the only company in out-of-home advertising operating with this structure. In July of last year, the company completed the Verd Outdoor transaction, which represented the first UPREIT acquisition in the history of the industry. The transaction added roughly 1,500 billboard faces, including around 80 digital displays, while expanding Lamar's geographic footprint across 10 states. For full year 2025, Lamar completed over 383 million worth of acquisitions across more than 50 separate transactions. In just the first quarter of this year, management already deployed another 80 million across 19 additional acquisitions. So this is not a one-time event. Management is clearly positioning the company for a multi-year consolidation opportunity within a fragmented industry where they possess a structural advantage no competitor currently has. The third pillar is capital allocation. In April of 2025, management repurchased approximately 150 million worth of stock at an average of around $107 per share, with most of the purchases occurring near the yearly lows. Those same shares now trade around $158. That demonstrates a management team that has historically shown discipline regarding capital deployment rather than simply buying back stock for appearances. What's interesting today is that the same board has already pre-authorized another 250 million in repurchases through September 2027. After the April 2025 buyback was validated, management still believes the stock is undervalued enough to allocate additional capital towards repurchases. The company has also increased its dividend from $4 per share in 2021 to $6.45 in 2025, representing roughly 13% annualized growth over that period. Total capital return to shareholders in 2025 was approximately 806 million against AFFO of roughly 846 million, while dividend coverage remained healthy at approximately 129 or 1.29 times. Overall, the balance sheet today is the strongest it has been in years. I also want to briefly address the primary risk associated with the thesis. The first is governance concentration. The Riley family controls roughly 63% of voting power through dual class shares despite owning a smaller economic stake. While that could theoretically create governance concerns, the company's long-term operating history has generally demonstrated disciplined stewardship and shareholder alignment over time. The second risk is competitive replication. In theory, competitors could eventually attempt to create their own similar UPREIT structure. However, Lamar has spent years restructuring itself before successfully executing the first transaction, and competitors uh, currently operate with weaker balance sheets and less flexibility. The final risk would be long-term digital saturation or advertising weakness. However, digital still represents a relatively small percentage of total displays today, and local advertising, which makes up the majority of Lamar's revenue base, tends to be more insulated than national advertising spend during weaker economic periods. So to conclude, Lamar Advertising represents a federally protected infrastructure asset with a long runway for internally funded digital growth, a differentiated acquisition strategy through its UPREIT structure, and a management team that has consistently demonstrated disciplined capital allocation over time. For those reasons, I recommend a buy on Lamar Advertising Company with a 12-month price target of $174. Thank you.